Hey gang, do you know what happens when price and momentum move in different directions? It's called divergence. I know it's a big word, I know it sounds very complicated, but today I'm going to demystify it for you and I'm going to show you how divergence can call market bottoms and market turns. Stay tuned. Today you're going to learn something eye-opening. Not a lot of professional traders or market experts talk about this, but it's very important to understand. This is called divergence between technical indicators and price action. And why is it important? Well, it gives us a good indication of a market that's bottoming out. It doesn't necessarily tell us when it's time to buy, but it does tell us when markets are changing direction. And that's the number one questions investors are asking right now. When is this market going to bottom out? So let's talk about it right now. As you could see here on the 11th, the RSI oscillator, which measures momentum, was at 1911. That's a very low number. As you could see here on October 26th, the low was 3297 and the swing low before that was 2580, substantially above 1911. As you could see here, the lows are getting higher. Now when you look at price action, the lows are getting lower. The low here was 248. The low here was 244. The indicator lows are getting higher. Why is this important? This is telling us that the market is running out of momentum, downwards momentum pressure on the way down, and telling us that momentum levels have peaked out to the bottom side. When there's divergence, and that's what we call divergence, when price and momentum diverge from each other via the oscillator, it's telling us that price is bottoming out. It's telling us that the oscillator is running out of downside momentum and it can't go lower and it can't reach these levels. And we usually see the oscillator turn before the price change does because this is a leading oscillator. It's measuring momentum levels. Now, are we out of danger zone just yet? No, we're not. This is the 200-day moving average. We have to trade above the 200-day average at least for 2 days where the clearance of the trading range is completely above the 200-day moving average. But divergence with the lows on the oscillator versus the lows on price action is an amazing start to all of this. And just to let you know, it's not just the Dow Jones that we're seeing this on. We're seeing this on the S&P 500, the same type of pattern. And we're seeing it on tech, as you could see here as well. There's no difference. We're seeing momentum diverge from price on all three major indices. And because this could be a complex topic, I made it easy, but it could be complex. I'm including an article in today's video, so you can learn more about divergence and how it impacts price action. We've been getting tons, and I mean tons of amazing feedback from all of you, and I really appreciate it. If you want to reach out, please do. Roger@wealthpress.com. Talk soon.